Mistake number one that most people make when it comes to investing is not actually investing into their financial education, right? I'm not saying that you need to be an expert when it comes to investing before you actually get into the markets. I'm saying that you need to at least understand the basics of what you're about to get yourself into. Right? After all, it only makes sense if you go out and do so. It doesn't matter what you're investing into, right? Your priority should be investing into your financial education first before you actually get into investing. Right, now I get that not all mistakes can be avoided. Essentially, we have to make those mistakes in order to learn and move forward. Hey, what's up people, welcome back to my channel. We're talking all things investing and personal finance. If you're new here, my name is Robert. Welcome to Power Finance. If you do get value from today's video, make sure you smash that like button. I invite you to join the journey to financial independence, so consider subscribing to the channel. Trying to time the markets. Yes, that's mistake number 2 on my list of investing mistakes that people generally make. Now, one of the biggest consequences of trying to time the market is that it will almost certainly leave you in regret. Right, when you try to time the markets, there's a high probability that you'll get it wrong. And when you do get it wrong, you'll miss an opportunity to get in that discounted price. But here's the scenario, guys. You're waiting for a stock price to fall, right? But it doesn't quite fall to the area you want to buy in at. So as you're waiting and waiting and waiting, the stock price rebounds up to the upside before you manage to get in at the bottom. So as you see the stock price going up and up and up during this bull run, your fear of missing out kicks in. And what do? You jump straight into the markets blindsided, thinking that the stock price will continue to go up and up and up. And trust me guys, when fear of missing out kicks in, your emotions tend to rule over. And we're going to be talking about that later on in the video. If your investment strategy focuses on timing the market, I'd advise not having that one particular strategy as your main strategy. But hey, I'm not a financial advisor, so please consult one if you do wish to do so. Another investing mistake that is commonly made is the lack of diversification in portfolios. The lack of diversification is one of the best ways to lose money in investing. Right? If that's your plan, go ahead by all means, but it's the foundation of investing. Right? So treat diversification like building your own mutual fund by allocating your money into different sectors of the market. Now hear me out. An undiversified portfolio is not all bad. Right? For example, in a stock market bull run, it can produce some staggering returns. But also on the flip side, when the market is in a bubble and that bubble bursts, you're finished because it could clear out your entire portfolio. There are 2 ways you can diversify a portfolio, right? The first being diversifying in different asset classes. For example, you could invest into stocks, index funds, or ETFs. And the second being diversifying within asset classes. For example, instead of investing all your capital into one company, you can spread it out across different companies in different sectors of the market. It's crucial to have a well-diversified portfolio in a bear cycle of the market. Right? Trust me guys, I've been there before when I first started investing. There's too many nerves and stress. Yeah, it's not a position you want to find yourself in. So just do better than I did back then, guys. Ultimately, it depends on how much risk you're willing to expose yourself to. Because research shows that having a well-diversified portfolio can bring you better risk-adjusted results in the long term. The next investing mistake that people normally make is not doing due diligence before investing. Every investment comes with some sort of risk. So I'll just tell you this now. You are not guaranteed to make money in the stock market. And I'll repeat that again. You are not guaranteed to make money in the stock market. And whoever says they can guarantee you that, then they're just trying to swoop in and collect your money. There are a lot of people that invest based on what they see on social media or in newspaper articles and what people say. But the problem is that when they hear or see those things, they don't actually dig deep and do some more research into why those are actually investment opportunities and how they are good for them. But they just jump into the markets blindsided with no idea what that opportunity is. So they're just following someone's voice or someone's post on social media. It's critical to understand the asset you're investing into before you actually invest in it. Because you need to understand what the company is, how they operate as a business, and how they generate profit to keep their business alive. Lack of research can lead to big losses on your investment. So if you're someone that jumps into investment without actually doing your research first, I recommend that you do your due diligence first before you actually invest into that asset. Otherwise, it will just be gambling. So you might as well just go invest your money in a casino while you're at it. But please don't say invest your money in a casino. But seriously, please don't. The last investing mistake we got on the list today is letting your emotions rule you. Don't be making investment decisions when you're emotional. Instead, leave the emotions out of it and look at the factual data that's presented in front of you. For example, don't be investing into a company because you have some emotional connection to it and you know that that company doesn't do well as a business, but you're still investing into it because you have an emotional attachment to it. Leave the emotions out of it and look at the documents like the balance sheet, income statement, and even their 10K document if you have to. But all that needs to be done by you is to just leave the emotions out of it and just look at the statistics. Even when the market is in a bull run, don't just jump in blind without analyzing if that's the right investment decision at the time. Leave the emotions out of it, because most people, when they see a market bull run, they just jump in blind because they have a fear of missing out on making some more profits, right? Without actually analyzing their investment decision, if it's the right one or the wrong one. But when the market reverses on them, they start to panic and their emotions rule them, causing them to panic sell on those positions in a loss. Let's be honest though, we've all let our emotions cloud our judgment in the stock market here and there, unless you're using a robotic machine to trade for you. That would be very interesting. So there you have it, guys. This was some of the investing mistakes that I made when I first started out on my investing journey. And you can simply stop making these mistakes by being aware of them. And you can stop other people from making the same mistakes by liking the video and sharing it out to other people as well. Consider subscribing to the channel and turn on the notification bell while you're at it as well, so you don't miss out on future content like this every single week. Until next time, guys, I'm out.